Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week we're dipping into a recent report from the CIO of UBS Global Wealth Management focused on private markets and the prospects for investing in renewable energy infrastructure. Now, renewables account for the majority of energy capacity additions globally, and governments have recently committed to triple renewables by 2030. Today we'll hear how private infrastructure offers opportunities to invest in this space. Infrastructure assets can act as an attractive diversifier due to their low correlation to other asset classes, as well as being a stable source of income and returns. As well as all that, our panellists today will explain how investing in renewable infrastructure contributes to a number of the UN SDGs and aligns to UBS's longer-term investment theme on clean air and carbon reduction. So let's get started with Antonia Sariyska, Sustainable and Impact Investing Strategist in the CIO of UBS Global Wealth Management. Antonia, welcome. Let's jump straight in and talk about sustainability first of all. Are we at an inflection point when it comes to this narrative? Are we maybe beyond that point now, Antonia? I guess it's an interesting moment, isn't it, either way?
Definitely. And actually, if we look at some of the commitments that we have had over 2023, both in terms of increasing corporate commitments towards decarbonization, as well as intensifying public policy spending programs such as the US Inflation Reduction Act or the Repower EU within the European Union. And of course, the COP28 discussion in Dubai at the end of 2023 that really focused on the need for a transition to a low carbon economy, as well as the need to triple renewable energy capacity around the world. Definitely an inflection point that we're living in today. And that trend of decarbonization has become really a secular driver of where capital is going and where corporate commitments are going.
And Antonia, let's talk a little bit about the ways that renewables help in this space, because obviously there are so many different drivers to decarbonisation more broadly. That might be about, the transport sector or electricity generation. Just talk us through some of the key ways that this change is actually being driven.
Yes, of course. I mean, the whole point of, renewable energy generation is to clean the energy mix. So that means that over time, we should be replacing fossil fuel generated energy and electricity with those clean sources of energy and electricity like solar and wind and hydro and some of the, more advanced or more exotic forms of biofuels, waste to energy, sustainable aviation fuels, and so on and so forth. And that clean energy mix would essentially allow, especially the decarbonization process at industrial companies, so those very highly pollutive companies within industrials or materials or traditional energy. And as they increase the share of renewable energy in their own operations and supply chains, then hopefully that also helps them decarbonize their own processes. So overall, renewable energy really is that initial driver, that initial push that helps broader industrial decarbonization of our economies.
Antonia, one thing that I thought was interesting in the report, and this is worth underscoring or at least pointing out, is that despite the broadly positive picture you paint, renewables, of course, can produce some negative externalities. And I think it is always important to make that point, isn't it? It's not just a one-way street, I guess.
No, it's not. And I guess one of the key negative externalities that we point out, but that are also need to be considered by the broader kind of investor community or by people looking into renewables more broadly, is that effect on biodiversity. So if we think of infrastructure deployment, and renewable energy is no exception to that, essentially we're deploying physical assets on top of fields, on top of ecosystems that includes a number of different plants and animals and different species. So one of the key, negative externalities we need to manage against is that preservation of biodiversity on the sites where the infrastructure is deployed. Of course, there's been a lot of advancing regulation just to make sure that, there's programs put in place or precautions put in place by infrastructure developers. So for instance, you wouldn't be allowed to build wind turbines on the migration pathways of birds. You need to be very careful in terms of the local plants ecosystem and where exactly you built that wind turbine and so on and so forth. But of course, there will always be some negative impact on the biodiversity system around those structures.
Yeah, let's talk a bit about impact, because obviously you're working in the sustainability and the impact investing space. If you have, I don't know what you'd call them, impact investors looking at this area, at renewables infrastructure, What other factors, Antonia, do they need to keep in mind? Because I know in the report it touches upon some other key areas, again, that may not jump out at first instance, things like additionality, intentionality, measurability. Can you just tell us a little bit why some of those things are so important to keep in mind?
In our experience, impact investors tend to be focused on their own positive contribution towards environmental or social impact that wouldn't have occurred otherwise. And when we talk about additionality in renewable energy deployment, we are often thinking about adding new capacity to the clean energy system. So that means not simply purchasing an already existing wind farm or a hydropower generation infrastructure, but also adding new capacity to those, building brand new structures, and essentially increasing the overall supply of clean energy into the mix. So that's a form of additionality that impact investors is quite keen on. And that's why mostly when they look into renewables investments, they're really focusing on those greenfield investments, those brand new developments. In terms of measurability, that's extremely important in impact investing. And I guess when we think about renewable energy, our focus tends to be on the potential of those investments to avoid carbon emissions. So emissions avoidance, I guess, becomes the key metric that investors will be looking at. And ideally, these emission avoidance projections are done already at the project level. So when you decide to build, let's say, a new wind turbine, what is the potential emissions that you could be avoiding by deploying that? And then how does that actually work out in the long term once that turbine becomes operational and once you're able to feed electricity into the grid? So additionality and measurability definitely very important in that impact investing space, also when it comes to renewable energy.
Yeah, for sure. And we're going to talk a little bit more in terms of the sort of private markets opportunity with Antoinette in a moment or two, Antonia. But looking at through this your sort of lens of sustainability themes, impact, I guess what is compelling, and we kind of circle back to where we began, investment in this space, in renewables infrastructure, it doesn't just contribute to those UN SDGs, which you mentioned, but it sits alongside and across so many other secular themes. If we think of investment thematics we've discussed on this programme before, clean air and carbon reduction, for example, this is one of those things where, it ticks it ticks a load of boxes, I guess, at the risk of making a trite observation.
It does. I mean, there is obviously many economic rationales why investing in renewables might make sense, right? It's by now one of the cheapest forms of electricity, especially in developed markets such as Europe and Americas. It also allows us to connect to grid infrastructure, so potentially deliver actually access to electricity to communities that might not otherwise have stable access to electricity. But on the sustainability side, of course, clean air and carbon reduction is a very key thematic there, right? That potential to avoid carbon emissions and ultimately get on a path of decarbonization. There is also implications for other areas around energy efficiency, for instance, and again, how efficient those grids are, how we are able to connect with each other. Of course, there's also implications towards just more broadly infrastructure development, both in developed and emerging markets. If we think of the renewable energy space, but also things like energy storage or grid connectivity, very important to the thematic of infrastructure more broadly.
Antonia, just in terms of the pace of change, we've discussed the idea of this inflection point, maybe passing the inflection point even, but just give us an idea of why you and your colleagues are so confident about the pace of acceleration in the space.
Yeah, thanks, Tom. And we are quite confident that pace is going to increase in the future. And we already mentioned some of the broader corporate and policy-making commitments out there in the space of decarbonization. But there's also a couple of other factors that give us that confidence. I guess the first one, a very critical one, is the decreasing cost of the technology. I mean, by now, and we mentioned that several times as well in the report, renewable electricity can be the cheapest source of electricity in many countries' grids. Which means that economically, households and companies will be more incentivized to be using renewable energy in their consumption. And I guess a second critical one continues to be that really increasing public policy and spending support. So again, advancing regulation is likely to make renewables a continued more favored source of electricity more broadly.
Antonia Sariyska. Well, next, let's turn to Antoinette Zuidweg, alternative investment strategist at UBS's CIO, where she focuses on private markets. Antoinette, a warm welcome back to the programme. Always a pleasure. So we're continuing this discussion of the piece, looking at private markets and specifically at investing in renewable energy infrastructure. I guess actually let's start with the big picture in private markets terms. Talk to me a bit about infrastructure as an asset class, first of all. Why is this an area that is so interesting?
So let's start there. Exactly. So infrastructure as an asset class, why is this interesting for investors, particularly for private market investors? Infrastructure as an asset class has not been as available to private market investors as it has been before. So it was more for the more sophisticated or very institutional investors that would seek exposure to this asset class historically. And even before that, it was really a government-driven thing. So this goes back to a history of privatization where you've seen more institutional investors then step in. And now we also see this possibility for private market investors to seek exposure to this asset class. And this is something that we find very interesting. And why is that specifically? So if we look at an allocation or private markets allocation, we think that it makes sense to have also some exposure to infrastructure in here. And let's start maybe with a little bit of a background on why we think that is. So if we look at the current situation where we find ourselves, we still have a little bit of sticky inflation around in the current market. And typically this is an asset class that does quite well in times of that. Moreover, this is really the asset class, the infrastructure that sits at the center 5 key trends, or really at the heart of these 5 mega trends that are set to shape the coming decade. So here, think of deglobalization as more economies and countries will have to onshore infrastructure, changing demographics with aging populations, but also growing urban areas requiring infrastructure, digitization, where we'll see a higher need for data networks and data centers. And then also, finally, decarbonization. So this was really, the key here of the discussion today. And infrastructure has a very long-term focus. It fits right into these areas. So that would be the first reason why it would fit well within a private market, really a long-term type of portfolio allocation. Infrastructure does have the ability to deliver stable returns over the full business cycle. And if we look at Cambridge Associate data, this shows that private infrastructure particularly delivered annualized returns of 10.8% over the past decade. And we can compare this to 7.6% for global equities over the same period.
Yeah, for sure. And I think it's interesting, this asset class, it has lots of other attractive features. And I guess one, we often come back to the D word, don't we, about diversification, but infrastructure assets presumably are an attractive diversifier. They have low correlations against other asset classes, and they can do other things. A stable source of income, for example, they can offer some attractive returns within that broader portfolio context. I guess, again, that kind of makes it a win-win from your point of view.
Yeah, so I think that is a good point that you're highlighting there. So I thought at first to give a little bit of background before we dive into really the specifics. So indeed, infrastructure has some very typical or unique characteristics. And infrastructure assets, specifically core infrastructure assets, typically come with high barriers to entry and monopolistic characteristics, and are often contracted and regulated, and moreover have really these cash flows that are linked to inflation. So basically throughout the entire business cycle, but also in times where we have higher inflation, this is an asset class that performs well throughout. And indeed, as you mentioned, there is also this aspect of having lower correlation to other asset classes. So with the lowest correlation to bonds and up to 0.52 to equities. And this also makes it an attractive diversifier within an investor's portfolio.
Yeah, absolutely. Well, let's talk maybe a little bit more then about some of the additional detail, Antoinette. Tell me a little bit more about, I don't know, the precise nature of the opportunity as you see it. What are some of the key factors that inform the conversations when you're advising clients in this space?
So I think a lot of questions that we also get from clients is then what are we actually getting exposure to with infrastructure? Because that sounds very broad, right? So as I mentioned, on one hand, you have these access to these megatrends, and one area that is very big here, of course, is digitization. But then, of course, renewables is a very, very big part of that as well. And core renewable assets, so think of solar and wind here, have seen really a large boost over the past years. But what we also see here is that this is really a key area of focus for the coming decade, specifically to really reach the net zero targets. There's really significant investment or private investments as well required in infrastructure assets. So if we take maybe a step back and look at the broader infrastructure investment gap, then we see investment needs not meeting the investment trends at the moment. So by 2040, we expect to see a gap or an investment gap of $15 trillion using Global Infrastructure Hub data. And then if we also look at renewables specifically, then we would be looking at a need or an investment need on an annual basis of $2.6 trillion.
I did want to ask you a little bit about risk profile, because I always think that's worth flagging, Antoinette. And of course, I guess we know there are general private market risks, things like illiquidity, some more limited transparency, perhaps control questions. But as well as those, I guess there are some specific risks when it comes to private market investments in this space.
So for renewables, this is an area that has some specific risks related to it, but also maybe, again, let's take one step back. So when it comes to renewables, core renewable assets do have the ability to provide some consistent yield, and they're also often contracted and regulated. So that makes it attractive. But then on the other hand, assets like solar and wind tend to also be sold to the energy grid at set prices, which brings down stable revenues. But this also can vary based on power usages as well as on weather patterns and grid capacity. These are then also risks that can impact that a little bit. And moreover, then the risk related to private market investors also or investment also stand. So here it's also important to consider really the long-term nature of such an asset class or of putting money away for longer in an area like infrastructure, but also the illiquidity and other potential considerations like leverage or the potential for default and policy and regulatory changes that may have adverse effects on asset valuations. I would note here, however, this is an area that is receiving a lot of policy tailwinds as well. So across the developed markets, so ranging from the US with the Inflation Reduction Act to Europe with the European Green Deal. However, policy changes may also then affect future investment in the area.
And that's Antoinette Zuidweg bringing us to the end of this edition of the Bulletin with UBS on Monocle Radio. You can listen again at monocle.com. That's where you can also join the club and subscribe to Monocle magazine. You can also follow this programme wherever you get your podcasts. And as always, you can discover more and find out how UBS can help you at ubs.com. I'm Tom Edwards. Thanks for tuning in.